Okay, we're back after a pause of some duration here, and what we're going to be discussing is the different categories of tainted income that can become subpart F income. The first category actually becomes an exception to the general rule, so we're going to not spend so much time on it right now. We will come back to it at a later time, but it is the foreign personal holding company income, which can become subpart F. And the reason why this is the fun part of taxation, is I just got finished going through a whole litany of how you had to make the CFC rules. You had to be having 10% greater shareholding, 10% or more to be a U.S. shareholder, and then all those U.S. shareholders have to own greater than 50%. Well, the foreign personal holding company income does away with that rule, and the reason is because what is the foreign personal holding company all about? It's about capturing really what is passive income or portfolio income, dividends, interest, royalties, rents, annuities, that type of thing, not a trader business. And what taxpayers are doing is they're investing their money through a foreign corporation, and they're investing in these kinds of assets, and then they're saying, well, until dividends are paid, no U.S. tax is paid down here until the dividends. And so they get into a low tax rate country, invest there in all these kinds of investments, and then avoid paying tax, or at least in the U.S., because they just hold it over there, and they can choose when to pay the dividends or not to pay the dividends. And so in this case, the 10% shareholding rule is out the window. We don't have that 10% shareholding rule. There's no threshold really. If you just have something called a foreign personal holding company, then you're going to have to pay tax in some manner on this income currently, or in some other manner, which we'll get to when we cover these entities in a later class. For now, just be aware of the fact that it exists, and it's an exception to the general rule where you had to have the 10% or greater shareholding. So that's isn't that fun? All right, moving along and staying with this is what it would look like, by the way. The PFIC, this personal foreign company holding income, is you get your friends to invest in call it a mutual fund, and then you buy assets through a foreign corporation, invested in portfolio income, and then no U.S. tax until the dividends are paid. So you can say, well, I'm not paying dividends, and avoid U.S. taxation on the earnings, and a low tax haven wherever this foreign company is incorporated. And it doesn't include rents and royalties, which are from a trade or business. Then it'll go back to, is it a CFC, where you have to have the 10% or more. Again, more about that later on. Let's staying with the general concept of outbound transactions that are business related, business based, and let's first talk about foreign based company sales income. This is where you actually have a trade or business overseas. You're getting gross profit from the sale of personal property, and it has to meet some requirements. First of all, for sure you have to be a CFC. We've gone through the definition of that, what that is, and now once you've come to the conclusion you are a controlled foreign corporation, the next question is, do you have subpart F income? And that's where we are now. We're trying to determine, do we have subpart F income? So what is it? Well, the CFC buys goods from or sells them to a related person. So we're going to have to meet all these criteria. The next step is the property is manufactured, produced, or grown, or extracted by a party other than the CFC outside of the country, outside of the CFC's country of incorporation, and on top of all that, property is sold for use consumption outside of the CFC. So I think now with the introduction that we've done in several videos actually leading up to this, you can see that the rules are designed to capture what we were talking about. It's a foreign corporation. It gets the definition of a CFC by meeting the shareholding rules that we talked about. And now the question is there subpart F income? Well, are they doing business outside of the country? To the extent that they're doing business outside of the country, both by bringing it in and sending it out, by manufacturing it there and sending it out to related parties into another country, then it's not a legitimate business. It's not a legitimate business because it's to a related party. Be a related party of a corporation, a distribution center in another country, and it's selling it from there. And what you're doing is you're avoiding paying tax to the U.S. by holding back dividends. And you may be in a country that, with the CFC, may be in a country that has a very favorable tax situation for you. Now, let's see, continuing. So if it's not manufactured for use in the CFC's country and not sold, so it's both. If it's not manufactured or sold, nor sold for use in the country, it's assumed that it is a CFC subsidiary based company to avoid tax. It gets that presumption. So if it's not manufactured and it's not sold for use in that country, then it's assumed that the CFC is not a bona fide foreign manufacturing marketing subsidiary, but it's a tax avoidance, and under the CFC rules, something's going to happen. Let's take a look at the picture. First of all, you have USA Co. If they send their products to the foreign company in Norway, and the customers are Norwegian customers, well, this side of the picture in this color is okay. That looks good because it's all the business is done here. So far, this particular side of the picture is fine. This is not subpart F income over here. However, if you go to this side, and what the U.S. company first does is send the product to Belco, which is in Belgium, and Belgium then sells it to the related party, Norco being related to the U.S. company, this is subpart F income. That's where we get it. That's subpart F income, and it's going to be subject to the subpart F income tax. So this picture gives you an idea of what you have to do to avoid subpart F income and what you're doing that doesn't avoid it. What about foreign-based company services income? Well, as you can imagine, that's services, and it's for any compensation, commissions, fees, or other income derived from the performance of a lot of things: technical, managerial, engineering. It looks like all the professions, and then more. Where the CFC performs the services, again, for a related person, and the services are performed, keyword, outside the CFC's country of incorporation. So again, the same concept. You're winding up using a foreign entity in a foreign country, and your main cross-border transactions are not even in that country, or there are some that are not in that country, and to the extent that they're not in that country, it's going to be tainted as subpart F income, in this case services. Here's an example. USA company sells to both French and German customers drill presses, and they do maintenance services. So to the extent that the services are done in Germany for a German corporation, not a problem. But if the services are done by the German company for French customers, they are, and it's sold to the French corporation. Let's write that again. Sold to the French corporation, or the related parties are the customers of the German corporation. So it's sold in, why did I write French? I should have wrote France. Let's do it that. If it's sold there, the services are sold there, the maintenance services per se, and even if the sales, same thing, but let's just talk about the maintenance services. So if they're done in France, that's going to get tainted as subpart F income. So again, you see this general concept of where is the service rendered? It's not rendered in the home country of the corporation. It's rendered somewhere else. Now, there's some exclusions. This will sound familiar. Let's do the one that should be familiar first. It's not even here. Well, one exclusion we talked about before is if the foreign country's corporate entity is taxed at 90% or more of the U.S. rates. So let's do 90% or more of the U.S. rates. If that's the rates in the foreign country, this tax avoidance is not happening. That's not tax avoidance, so it's not subpart F income. We had mentioned that concept before, and now this is the rule. In the event that the foreign entity in the foreign country here has rates that are at least 90% or more of the U.S. rates, the assumption that it could be a corporation trying to do tax avoidance goes out the window. So any sales that it has outside of the country will not be subpart F income. So in this case, the key is that even if all of it is sold outside, it's not subpart F income because it's in the country that it's in. It's paying rates that are almost the equivalent of the U.S., so where's the tax avoidance? So that's one exception. Another exception is what you see here. It's not an exception actually to subpart F income, but it's an important addition. And it works like this. If in step 1 we determine that we have a CFC, so step 1 is we have a CFC by the shareholder rules we talked about. Step 2, we determine that we do have subpart F income. Again, the rules are very, very complex. I just want you to get the basics. If we find we're CFC, yes. We find we're subpart F income. Then the step 3 that happens is that income is going to be taxed currently. We're not going to wait for dividends. It's going to be taxed currently, like a flow through. The income will be considered earned in the U.S. And the U.S. corporations or the U.S. Let's write this: do not wait until dividends. So it'll be taxed currently. And the U.S. shareholders, according to the subpart F income definition, which are the 10% or greater, the U.S. shareholders will have to pay the tax now. Pay tax now as it's earned. So step 1, CFC, yes. Step 2, do you have subpart F income? Okay, we do. Step 3, you pay the tax now, you don't wait. That's the result of being a controlled foreign corporation having subpart F income. Now, once the tax is paid, and we can come back to this sentence in the middle now. So let me erase the deck. So once that tax is paid on that income, when that income is later paid out as a dividend, the tax has already been paid on it. So when the dividend eventually gets paid, it's been previously taxed. It's not income to the shareholder, and no tax is paid on it then. And that just makes sort of fair and equitable sense. All right, that takes care of CFCs, subpart F. You now are equipped to be dangerous because there's a lot of regulations, a lot of exceptions to the rules, and then exceptions to those exceptions. But you got the basic idea, and we'll be talking more about it later in the semester.